So can commodity investments be a big boom or a bust for average investors? Here to tell us is Todd Bubba Horwitz of Bubba Trading, who joins us from Chicagoland. Hey, Todd, how are you?
Great to be with you again, Bart.
So, you know, as a guy that used to regulate these things, not trade them, but I saw a lot of average guys, and some of them got burned. I remember a guy got burned in OJ at ICE Futures because he, you know, placed a short on OJ after a freeze, but he forgot about orange juice can be imported from other places. So people can lose money, but tell that generally these investors who are average investors primarily in equities, the difference between equity and commodity investing, Todd.
Well, Bart, I think it's really simple. Firstly, if you're going to be a commodity investor, you're not really a trader, so you're not looking to get to the short side of the market, so you can't take some of these poundings that happen. You know, markets have crazy moves, you know, all markets do, but in the commodity markets, they can move up and there's nowhere to go. So it's easier if you're going to trade commodities and invest in them, which I think are a great investment, is to be a buyer only and look for certain opportunities where you're willing to hold on to them. You know, many of the farmers today in the market are storing their grains as an investment. They look at it as a bank account because grain prices are so low right now that they're going to hold on to it because they know that grain prices most likely can only rise. And it's like, you know, looking for a value on a stock. So I think investors should be looking for value plays like they do with stocks that they can hold on to these commodity contracts. And again, I'm a big believer in the actual commodity itself. The ETFs cannot account for a lot of things that happen in markets, and there's different pricing mechanisms that drive these markets, and it's a little bit too complicated to explain, but they sometimes they're priced awkwardly, so it's easier to own the commodity because the funds and the ETFs do not know how to take those prices out, and they really just charge the cost back to the customer.
Okay, I want to get to the ETFs. Those are exchange-traded funds for the boom busters. But first, Todd, let's get back to the differences. So, you know, when you're trading a commodity as a future or as an option, you're talking about the real deal, the physical thing. And those fundamentals, the price discovery process, you know, it's supposed to be based upon supply and demand, right? And then liquidity and trading, of course. But how is that different from equities in that, you know, equities, you know, you can go buy a stock now. There's no limit on the demand. You keep buying the things.
Well, I think what you're looking at, Bart, is that in the equity markets, you have got, you know, earnings to deal with. You've got companies. You could have, you know, some internal strife within a company. Commodities are raw. They're going to go up or down based on the true price discovery model. They're going to go on based on supply and demand, and they're going to go on based on certain events that are happening, whether it be a weather event, whether it be, you know, another event that drives these. But you don't have to worry about some CEO doing something wrong that's going to cause the commodity to fall. They're raw, exactly. They're straight, and they trade as fair as they can possibly be. So I don't think there's any reason for anybody to go out and for equities because, again, you're looking for a pure investment. There's nothing more pure than commodities.
Yeah, well, I agree with you from that perspective. Okay, well, let's get to exchange-traded funds. So there's a couple of different things for average investors. You can get an exchange-traded fund that actually trades as an equity, so it could be an equity in a portfolio of companies that deal with commodities, or you can get an exchange-traded fund that just actually owns the raw commodities. But you're saying that it really, to take some of the mishmash out of it, to focus on the real fundamentals, that getting involved in the actual commodity through a futures contract or an options contract, that's the better approach from your view, right, Todd?
That's 100% correct, Bart. Again, there's things that happen in commodities, and they sometimes, today's price is one, and out 6 months from now it might be cheaper, but when those start to roll over, because commodities have to be moved, they have expiration dates like anything else, and the funds take advantage of those and actually charge all those costs back to customers. So they don't get true movement. If you buy the raw commodity, it goes up, you get paid. If it goes down, you either take your loss and get out, or you hold on. So again, you're getting true price movement, and you're not worried about what's going on behind the scenes with some of these ETFs.
Hey, Todd, I know this was a little bit of a 101 for you, but it's important for our investors. You know, we've got average people all over the world who look at this stuff, so we sure appreciate you being our professor today. Todd Bubba Horwitz of Bubba Trading. Thank you, Todd.
Thanks, Bart. Have a great day.